Hello, everybody, and a warm welcome to members who are viewing today's presentation, as well as any prospective members who might be tuning in today. And if you are a prospective member, stick around to the end of the presentation, and we can give you some more detail as to the premium service. Today, we're just going to take a quick look at money management, particularly in the stop loss department and stop loss discipline. Why is this so important? The money in your account is your inventory, and if you run out of inventory, you are out of business. And we need to treat our trading like a business, and we need to have a set of realistic expectations of how our business plan is going to unfold, and we're going to look at this in detail in just a minute. How much should we risk per trade? I would say 6 to 8% is a good starting point. And don't confuse the issue that 6 to 8% is on each individual trade of your portfolio. So you don't want to risk any more than 0.5% to 2% of your entire portfolio per trade. However, as we gain some experience, learn to enter trades at the most advantageous point and recognize when stocks aren't acting well, we can take this average loss rate down to, say, 5 or 6% over time, which will greatly enhance our returns. Now, we do need to consider at times stock volatility, individual stock volatility. It's not realistic to set a small stop on a stock that is volatile and trades in a wide range. For instance, if we're trading a biotech stock or a small cap stock with a small float, and it may normally have a $2 range per day, a $2 stop is not going to work very well. So at times, we may need to risk more than that 7 to 8% per trade, and maybe risk 10 or 12%, but we can't change our risk profile for our portfolio. So we will need to lower that risk by taking a smaller position and widening that stop. So if we do get stopped out, we are still well within the range of our acceptable stop losses. So at times, yes, we do need to consider the volatility of an individual stock when placing our stops, but never lose sight of the fact that we do not want to lose more than 0.5% to at most 2% of our entire portfolio on a single trade. So why use 7% as a stop loss measure? Well, for starters, as a trader, you need to know and accept the fact that we're just going to be wrong, and we're going to be wrong often. There's really no room for ego in trading. If you're the kind of person who insists on being right all the time, you're going to end up being very disappointed, and you might want to find another endeavor because trading is not going to work out for you. The good news is, though, that we don't have to be right more than half the time, or even less than half the time, to still make impactful returns with our trading. So let's crunch some of the numbers and take a look at an example of that. We are going to assume, for this example, that we have a $25,000 account, and we are going to invest $4,000 per trade. We are going to assume that we only have one winning trade out of the 4 trades, and that winning trade is going to give us a 20% return. Now, why am I using 20%? It's somewhat of an arbitrary figure, but with the style of trading that I use, where we are trying to find leading stocks breaking out of sound bases, history shows that leading stocks breaking out of sound bases can return 15 to 25% before they start to rebase again. So again, just as a starting figure for this example, we're going to use 20% for our winning trade, and we're only going to be right 1 out of 4 instances. And we can see here in the first example, losing 7% per trade, or $280. That $280 still represents only about a 1% total of our entire portfolio. And after losing $280 on our 3 first trades, We make $800 on that fourth trade, and we can see down here at the bottom, we've only lost $40. Our account total of $24,960 is still in relatively good shape, despite the fact that we have a terrible batting average of 25%. And again, as we gain some experience and we get a little more savvy in our trading, and we can see when things aren't working out well, we can cut our losses shorter at times. So let's say we get proficient enough to cut those losses at 5%. So with the same thesis of $25,000 account, $4,000 per trade, and cutting our losses at 5%, and having one winner at 20%, we can see that we actually made money by being right only 25% of the time. So that's a really good example to show you how important it is to cut those losses short. Now, there is a profit formula that traders can use to set some kind of expectancy of what their trading might return to them. Some traders have shorter time frames and trade more frequently, trying to capture smaller gains while keeping their losses relatively small. While other traders, who may be swing traders to position traders like we are, have a wider time frame, and we expect to hopefully at least make a little bit of a larger gain when we find a winner while still keeping our losses manageable. And you can see this profit formula at the bottom of the screen. We simply take our win rate, okay, let's say we win 50% of the time, times our winning percentage, minus our loss rate, times our loss percentage. That will give us a figure. We multiply that times the equity per trade, times how many trades we make per year. And again, we're going to have to estimate these figures depending on what kind of trader we are. If you're a very short-term trader, you might make 200 or 300 trades a year. For our purposes, I'm looking to make a lesser amount of trades, maybe 50, 60, 70 trades per year. So I will keep that in mind when plugging in the figures. So let's take a look and run the formula. Let's see what we find. Again, some realistic expectations to start. We'd like to surpass our initial goals and make as much money as possible. That's our desire. But markets don't always cooperate, and there are times when simply your trading style may be temporarily out of favor, causing us to trade less or perhaps stay on the sidelines for some period of time and stay in cash. And in fact, incidentally, sometimes staying in cash during bad markets is the best way to outperform the averages. But let's take a look at this formula and plugging in some numbers. We're going to be fairly confident that we're going to hit 50% of our trades. We're going to make 15% when we're right. We're going to lose 50%, and we're going to lose 7% when we're wrong. We're going to use $4,000 in each trade, and we're going to approximate making 50 trades per year. And when you run these figures, you will find that you will make $8,000 on that $25,000 account, or a pretty good 30% return. 32% as a matter of fact. Now, I would suggest playing with these numbers, changing them around a little, change your win rate, ratchet down your winning percentage, ratchet up or down your loss percentage, play with the numbers, and just see where you come out. But with this in mind, we can now set forth a plan and have some realistic expectations of what our trading can do for us. And this graph is a really good example. You don't want to be fighting an uphill battle. This chart will show, with each loss taken, what return you need following that loss to get back to even. And we can see when we keep those losses smaller, 10% or less, we really don't need to make a big return on our next trade to get our money back. But as these losses grow at 30%, and at 50%, needing to get a double on our next trade to get that money back. Or even worse yet, all the way down to the fact that we would let a one stock regrettably go down to zero, you're out of business. So I really think this chart is a really good example of what can happen when you let losses get away from you in the market. So keep this in mind when we're trading. Set some realistic expectations, run the numbers, understand what kind of expectancy you can come up with for your trading, and that'll give you a really good basis for your trading going forward. For anyone who is not a member or is not familiar with the service, it's a dual service. We feel it's fairly unique. We have partnered with Greg Krupinski of TTPtrading. Greg trades in a very similar fashion to mine, although Greg is strictly a technical trader. I use technical analysis, but also mix in some fundamental analysis to qualify my trades. But our styles are very, very similar, and importantly, our money management is very, very similar. So whether you were to join the service and want to follow one trader or mix in both, it's pretty seamless. And for only $69 a month, there's a ton of information that you get with our premium service. We have daily recaps of our open trades and the daily industry index action. The weekends have thorough videos recapping our trading action, our open trades, watch lists. We give you constant new trading ideas daily and on the weekends. So we feel it's a great service. It's a great value. We also do have some free blog sites at trusttheprocesstrading.com and gktrading.net, where we offer a fairly limited amount of information. So you could also visit those as well. We do have a 30-day free trial, so you with no risk, you can come on over, check out the service, try it out, see if you like it. We'd be awful glad to have you there. That does it for today's brief presentation on money management. I hope these figures help you gain some understanding and the importance of cutting our losses short and staying in the game, because once we lose our money, we are out of business. So we need to preserve that capital if we're going to trade. That'll do it for today. Thanks for watching, and we will talk to you again soon.